Okay, so we're going to go ahead and get started on our next phase of our week 2, which is intercompany profit transactions regarding plant assets, like sales between the two different entities. Okay, so here are our objectives. We're going to assess the impact of intercompany profit on transfers of plant assets on consolidated financial statements. We're going to defer the unrealized profits on plant asset transfer by either the parent or sub. We're going to recognize realized or previously deferred profits on plant asset transfers. And we're going to adjust the calculations of non-controlling interest share in the presence of intercompany profits on plant asset transfers. Okay, so we're going to look at when you sell between the two companies, all right? And here are some guidelines. If you sell non-depreciable fixed assets, in the year of sale, you want to defer any gain or loss and then move the fixed asset down to its cost, okay? In continued ownership, you're going to go in and adjust the investment account to gain or loss. And this is important, you have to make a distinguishment for an upstream sale, which is sub to parent. You're going to have to adjust the non-controlling interest portion of that doesn't belong to the parent. Then you will restate the asset to cost. Okay, in the year of sale to the outside entity, you're going to adjust the investment account and non-controlling interest if it's a outside, if it's an upstream sale, and then again, you're going to recognize any deferred gain or loss. So this is if you have an outside entity. Okay, so Pam owns 90% of Sun at a cost equal to fair value. In 2016, Pop sells downstream land to Sun and records a $20 gain. In 2020, Pop sells the land to an outside entity at a $30 gain, and Pop's separate income was $140 in 2016. Okay, so let's take a look at this. The first thing is we have ownership of Sun's reported income of 140. So we'll go ahead and make the calculation for this 140 right here for the ownership, right, and for the separate income. Go ahead and do this for 2016. And then what we're going to do, we had a $20 gain, right? So we're going to eliminate that $20 profit on land when you sold it downstream. So if you sell downstream to your subsidiary, you don't want to be showing that profit. Okay, and then you'll just adjust the income and investment accounts accordingly. All right, and then Pop sold the land that cost $80 to Sun for $110. So there's the gain on sale of land right here, sales price minus cost. And so you have to eliminate it and basically reduce the land down to its cost basis. So you don't want companies selling in between each other and showing all this profit because they're under the same umbrella. Basically, that's what this is. Okay. So the cost basis is reduced to adjust the investment account to establish reciprocity with Sun's equity accounts at the beginning of the period, and the entry is made at the beginning of each subsequent period. So basically you just go in and adjust out at the beginning of each subsequent period. Okay, now let's say Sun comes in and sells the land for 4 years later at 130. The $20 gain that was previously deferred is finally realized when it goes outside of the company, not between parent and Sun, but outside of the company. So now you can finally take the gain. And then Pop will make the following entry to record the gain, basically showing a gain and increasing the investment in Sun. Okay, so now we're going to look at deferring unrealized profits, intercompany profit transactions of plant assets. Okay, so unrealized profits on fixed assets. If we have non-depreciable fixed assets, like land, for example, you defer in the year of intercompany sale, and you continue to defer by adjusting the investment in the sub and non-controlling interest if upstream. And then you recognize the full profit or loss upon resale to the outside entity. Okay, gains or losses on intercompany sales of depreciable fixed assets. So now we have something that depreciates, like a plant asset. You're going to defer in the period of intercompany sale. You're going to recognize the gain or loss over the remaining life of the asset and adjust the asset and depreciation down for gains and up for losses. Recognizing an unamortized gain or loss upon the sale to the outside entity. So once it finally is going out the door, then you can go ahead and recognize the gain or loss, but you can't do it when it's between the two companies. Okay, so let's do a downstream example. Pam owns 80% of Sun, acquired at a cost equal to the fair market value. On 12/31/2016, Sam sells the machinery to Sun for $30 profit. The machinery has a remaining life of 5 years from 12/31/2016. Sun disposes of the machinery at a book value at the end of 5 years. So let's take a look at this one together. Okay, so let's take a look at this downstream example. So let's look at Pam's versus Sun's books together. All right, so the first thing is, so the cash is going to be increased for the asset, and the accumulated depreciation is also going to be increased. The machinery is going to be decreased because you are getting rid of it, so you're going to actually be taking it off. I mean, basically, you're just taking it off the books for the amount that you sold it for, and I'm assuming that's going to be this $80,000. All right, and then here's our gain on sale, and then here's the credit to our machinery, and we're taking off the accumulated depreciation, basically taking the machine off the book as if we've done this before. Now, Sun's books are the interesting situation because Sun basically debits the machinery and credits the cash, just like they would in any other situation. So where things get really interesting is under the equity method when you have to adjust for that gain, because you don't want to show a gain on your books when you have a sub situation. So basically what you're going to do is you're going to record, you're going to come in, bring the unrealized gain into income, and then credit back, adjust out to the investment for the unrealized gain at the end of the year. All right, and then the gain won't appear in a consolidated income statement, but it will be included on the balance sheet just to show. And the consolidated, basically the adjustment has this effect. You have a debit to the gain and a credit to the machinery. So it kind of looks like, it's kind of making it like you have less machinery when you actually do have the machinery. You have to adjust out that gain. Okay, so now let's look at recognizing realized and previous deferred profits on the plant asset. So now we've previously deferred it, we're leaving it out there for a little while. Now let's see what it looks like when we recognize it. So if you have a previously deferred gain or loss, you're going to recognize it over the life of the depreciable asset, and there's a difference between the upstream and the downstream sales. The upstream sales, you'll adjust it in the sub account, your investment for downstream. You'll just make the adjustment within the subsidiary. The upstream, you're going to adjust it in the subsidiary account, and you have to also remember that there's a non-controlling interest involved. For the intercompany sales of the gain, you're going to adjust the asset, basically depreciation down. So you just adjust the gain against the asset. And then if it's a loss, then you have to up the asset and up the depreciation, which feels completely backwards, but it works. Trust me. Okay, so let's look at this continuing situation from parts of a gain, continuing to recognize parts of a gain with full effect from Pet to Sam. Now we have two different people, Pet to Sam, new one. Okay, Pet's income from Sam, we take, let's say it's 80. We take 80% of 80, right, plus the accumulated depreciation of 6. All right, and we show 70. Then we have to go in and find the non-controlling interest, and then here are the eliminations. So here again, I'm adjusting down investment and accumulated depreciation, crediting off machinery, and then I have to basically do a back entry to eliminate that depreciation expense because I don't want to have any income statement effects from intercompany sales. Okay, so let's look at the worksheet entries for Pet and Sam 2015. So the first thing that we're going to bring in is the machinery coming off right here and the accumulated depreciation. All right, and basically, so our investment actually is the 30, or I'm sorry, the 18. Bite my tongue. Excuse me. Bite my tongue. Okay. And then the next thing we're going to do is basically back out that accumulated depreciation. So we're basically kind of doing things backwards because we don't want to show that intercompany expense on our income statement in 2016. Same thing, we just continue to make our worksheet entries. Or for 15, we do the same thing for 16. Of course, you'll be in the first of the year, you'll be back. And as you can see on the very last sheet is where we do our final elimination entries for 2017, where we will come in and finally credit the machinery and take off the accumulated depreciation and adjust with the investment of Sun. And then also we're going to go ahead and back out that depreciation expense. It'll come up here in the investment in Sun. Or Sam. Sorry, Sun Sam. Sam. Okay, so let's look at if we have a sale other than fair value. If it's other than fair value, the intercompany sales of fixed assets and prices other than fair value will probably have some scrutiny by the shareholders. Particularly if it's an intercompany one, that definitely does not look good. And anything over the fair value moves additional cash to the seller, so that becomes kind of like a tax implication, kind of, if you're moving money around, it kind of becomes something that might, again, grab some scrutiny. Sales below the fair market value, transfer valuable goods to the seller, and so again, that's the other direction, is if you're trying to get something to a buyer. So the transfer of wealth definitely gets attention from regulating bodies and definitely should be looked at. Okay, so let's look at an intercompany sale where inventory is acquired as a fixed asset. Okay, and then the unrealized profit is moved from cost of sales in the year of sale, and the profit is recognized over the fixed asset's life. Okay, so if it's an inventory item which is acquired as a fixed asset. So for example, I'm just thinking in the back of my mind, the example I had from last year is, let's say you are a home builder, a construction company, and you have several different homes, and then you decide to build a home, like a model home, and that becomes a home that you're not going to sell, and you'll be doing the business out of that sale, or out of that home. Then basically something within your inventory, like your lot of homes that you were going to sell, becomes a fixed asset, becomes the front of your neighborhood. Maybe it's like the showpiece home, and you choose not to sell it. You're going to use it to showcase everything else for a couple of years. Then that would be an example of an inventory item moving into the fixed asset. Another item is a car dealership, and they decide they're going to use a van to haul the customers around while they're getting their cars fixed. That's an example of taking something out of inventory and making it into a fixed asset. If it's an intercompany sale of inventory which is acquired as a fixed asset, so for example, you buy a Honda shared from one Honda dealership to another, then the unrealized profit is removed from the cost of sales in the year of sale. Okay, and then the profit is recognized over the asset's fixed life, and these are the journal entries of what that would look like. Okay, so this concludes lecture videos for this week. Make sure you're getting all those discussion posts done. They are part of your participation grade. I just want to remind you to get started on that homework early, and don't hesitate to reach out if you have questions. Try to walk through these slides and really learn the process. It'll definitely help you in your studies for standardized tests, including like the CPA exam. And have a great week. Thanks for watching my videos.